I'm taking a look at all the interest rates I see because something interesting is going on. You can see right here it's kind of topping out right under 3%. If you can see this, it's 2.85%. You can pull this up on your own. This is the 30 year. Okay, it's the ticker symbol is TYX.P. And you see this right in here, it's kind of topping out, maybe a little bit of a top right around 3%. Okay, it came back in, that was about 3, and now it's coming back in down here at right at 2.86% right now. What's interesting is this: if we pull up the TNX.P. Okay, now this is the 10 year. Okay, it is a 10-year note, TNX.P. So this one is doing kind of the same issue. Topped out right at 2.9, a little lower, as you'd expect. It didn't get as high. And now it's coming back in right to this 2.76%. So again, right under 3%. Okay, and now if we take a look at the FVX.P, Treasury yield, the 5-year interest rate. Here's the interesting thing. Again, same exact issue. The top out right at 3. So you've got some kind of shape like this going on if if you're looking at interest rates. If this is the 5-year, it's at 3. This would be the 10-year. It's at 2.7-ish, right under 2.8. And then again, the 30-year is up here at right under 3. Okay, it's actually got a little bit of a slope down, if you remember. So this one's at 2.8. Okay, right here, 2.797, just a tick down from 2.8. So what I'm seeing is that all these interest rates all along the curve are making, again, a big kind of a belly shape or a smile kind of a shape, right? On the curve, okay? If this is your rates and this is your time, right? If you got you got your y-axis and then your x-axis, you got the curve here, right? So if this is your rate and this is your time, okay? So that's not good. I don't know. They're all hanging out right here at 3. Okay. Now the issue that I've always heard, this is the rumor, and this is the issue why 3% is a big deal. Crossing 3, like if this kind of a thing happens where you just get, a big move above 3 and then it kind of sustains itself like that, you got problems. The issue with this 3% rate has always been this, is interest rate swaps. The rumor is that all the big banks have generally targeted 3% swaps. So all the biggest corporations in the world have lots and lots and lots of debt. They swap that debt because the debt is never meant to be paid off. It's just meant to be rolled over continuously, and they do it at 3%. So anything under 3%, when all these years since 2008 and 9, when we've been doing QE, the corporate debt has grown and grown and grown into the trillions. They swap the debt with the big banks, the investment banks, the global ones, the big ones. They they pay the bank the difference. So if rates are at 2%, again under 3, the corporate will pay the 2% interest rate and then pay the bank the 1%. Okay, and if rates are above 3, well then the bank still pays the 2%, but the corporate still pays, they'll pay 3%. The corporate will pay 3% if the 10-year gets above 3, and the bank will have to pay the difference. So if interest rates go to 4% on the 10-year, the corporate would pay 3%, and the bank would pay the corporate 1% so that the corporate still has a 3% fixed rate. Okay, and that's how they can afford to take on so much debt. And there was an article back in the FT Alphaville a long time ago in 2010 that they've since taken down that detailed all of this with perhaps it was Unilever, the CFO of Unilever, that was detailing this for a writer. It was a woman writer in FT Alphaville. I've forgotten who wrote that, but I can look that up later. And that was where all this, they took it down because they got pushback from this, so you can't find that article anymore. I didn't save it. I thought it would be up forever. I didn't even see it at the time. I've only heard rumors about that article because I never saw the original. And that kind of makes sense. So that's where, let's in fact zoom out here to see let's go to the tnx.p and see where these 10-year, let's zoom out and go to a monthly. And you can see what happened here. Now, this is where it gets interesting, right? You can see what happened right here. You've got, look at this now. So this is right under 3, right at 3. That's 2.85. Okay, so this is basically 3%. You can see what happened. I mean, look, back here, big time problem, you know, big time problem. That was in 2019, okay? This was in 2013. And then look, I mean, I'd expect, well, I don't know if I'd expect or hope for, based on what would happen if all the banks had to pay out anything above 3% on all the trillions in corporate debt out there. The banks, they don't have the money. And so you can see this area right here, how it was a transition time, right in here, 2009 to 2012. That was right when QE was becoming a thing, right? 2009 is right there, 2012 is right there, and you can see really on the chart this area was a transition time because before, all right, going this way, rates had never gone below 3. And then you can see right in here, okay, right in here, something changes. Something changes in this whole area right here. And now rates, they cannot get above 3%, right? There got rejected. There was a big rejection. I'd expect another big rejection here. Well, yeah, my gut is that we don't. My gut feeling, and it is just a feeling, is that we get some kind of a big, bad, terrible move, okay, because of inflation and whatnot. And maybe not like that. Maybe something more realistic is, maybe like that. And then the big move, and still it would be crossing that 3% line right there. They're all at 3. Again, you've got this kind of a shape in the yield curve. Right here is the 3% line. And looks like something is lining up. Now, that is not a prediction. I don't know. It just feels like everything is lining up that way, and all we need is a catalyst that doesn't exist yet. Or it's unknown. Maybe it already exists in reality, and I'm just completely unaware of it, so it's not a reality for me. But we got something going on in the interest rates that they are lining up for a big paradigm shift in the market. And I think if we can stay on top of this, there's going to be money to be made in this area here. If you can get this, you only need one of these in a lifetime, right? You know, this when rates broke back here, this was the QE. Okay, all this stuff was the QE era, and if you could gauge that and see it coming beforehand, I couldn't. I didn't know. I had no idea how the markets worked when this was happening, when the big breakdown in rates was happening in 2009 and 10. And then with QE 2 and 3, when Bernanke started that QE, it was right around the time of the BP Macondo well blowout in 2012-ish, 2011, 2012-ish, where he implemented, I think it was QE 3 back then, which was insane. And I didn't know that deflation and QE would make asset prices just go like ape nuts, right? All the way to the upside. I mean, they got all the money into those assets. I didn't know that's how it worked back then. Okay, well now I do, and now maybe by the time you finally learn that lesson, that's how asset prices go up. Long-term, long duration assets. So those would be your tech stocks, the Amazon. That's long duration stuff. Now, this kind of a move, if we get some kind of a breakout here, where you have a paradigm shift in the market, as this was a paradigm shift, uh, you know, maybe that's the next opportunity. If you're on the right side of that, and I don't necessarily know how that's going to work, but I can guess. Now I can guess that you're going to have a return to uh, hard assets. Okay, not so much long duration assets, but a cyclical asset. So a production factory, a chemical factory, okay, even a coal mine, okay, some kind of hole in the earth. That's the kind of thing that might benefit from an increase, a long-term increase in the interest rates there, and the subsequent paradigm shift for markets, stock markets. All right, so this is something to keep an eye on, because if all of this plays out, all of this in here, there could be an opportunity for some real wealth to be created by people on the right side of it. And I don't know how it's going to end up. Maybe it's just everything goes down except for Bitcoin, and people holding gold and cyclicals are fools, and that's a possibility that I'm on the lookout for.